Good morning, good afternoon, and good evening. My name is Tony Martinez. I am the owner and founder of TKO Financial Network. I've had the pleasure of partnering up with some amazing agents. I've had the pleasure of partnering up with some amazing agencies. And whether you were referred to us by me personally, whether you were referred to us by one of my agents or one of the agencies, you're watching this video today because you've expressed interest in some type of insurance protection in the area of life insurance. And so I'm going to put you through a little bit of an exercise today. The idea behind this exercise is to give you a little bit of clarity as to the types of insurance policies that exist. My hope is that I could be as transparent with you as possible. My hope is that I can give you the understanding as to how these work, understanding the pro and cons to each of them, so that when you get back with your agent, you can let them know exactly which of the products it is that you're interested in. And if there's any last questions or illustrations that you'd like for them to run for you, you can let them know, okay? What we're gonna do for the next probably 30 to 40 minutes or so is I'm gonna talk about the four main types of life insurances that exist. I'm gonna be as non-biased as I can in giving you the pro and the con to each of them. I've had the pleasure of being in this industry now for approximately 16 years. I've worked primarily in the wealth management space and have taken a decision to work with the middle American market space and teach them what the wealth of America does with their dollars from a wealth accumulation standpoint, but also from an insurance standpoint. And so I'm a big believer of every one of these products. I'm a big believer that there is a need for every one of these products. It's just a matter of finding the right client that needs the specific type of product that they need. I don't believe that one product is better than another. I don't believe that one company is better than another. I don't have those types of biases, but I will tell you the pro and cons to each of the products. And if we get a chance to meet face to face, I'll even give you the pro and cons of what my opinion is of the types of companies. We run an independent agency, which means that we represent over 90% of the companies in the market space. So we're not employed by any one company. We have no incentive to lean you towards one company or the other. Our goal is to provide you with a quality product that you can maintain with us for a long-term period, giving us an opportunity to have annual reviews with you, giving us an opportunity to really see these products develop and grow with your life as it adapts, molds, and changes. So my request today, be in a quiet spot, right? Be with your significant other. If your significant other is not with you, you might want to, kind of pause this video and set up another time to do it with them. Have a notepad and pen with you, take some notes, and be willing to learn. If you do have an understanding of insurance, be willing to learn, because insurance does change, products change, and sometimes it's just a matter of having a listening ear to be able to understand the differences. So with that being said, we're going to go ahead and begin. At the bottom of this video, in the description, you're going to find a link. The link is going to be an exercise that you can do after you've watched this video that helps you determine a couple things. Number one, how much insurance it is that you need. Number two, a budget analysis to make sure whatever program it is you're interested in is within your current budgetary guidelines. And it's a great exercise that you can do with your spouse, and then afterwards share it with your agent. There's instructions on what you need to do in order to prep that packet the right way. And other than that, we're going to go ahead right and begin. Okay, so let's talk about insurance. Okay, particularly life insurance. We're not here talking about health insurance, disability, long-term care. We're here to talk about life insurance, because when people think of life insurance, they think of one thing, one concept. What is that? What's that one word you think about when you hear the word life insurance? If the word you're thinking about is death, you're right. That's how a lot of people think of life insurance. But the reality is life insurance is a lot more than just paying out a certain dollar amount to your family in the event that you pass away. There are very basic plans, intermediate plans, there's very advanced plans. We're going to talk about those. And while I'm talking about this, I'm going to be using the example of a 30-year-old, but please understand, you could take these numbers and put them according to what your current age is. So if you're 40, 42, 47, just adjust the ages that I'm sharing with you, and you'll see how all of these plans could make sense for you, or how maybe one particular plan makes sense more than another. So let's first talk about the most basic of insurances. The most basic of insurances. I love to use analogies because analogies give people perspective and understanding of differences between them. The first plan we're going to talk about is called term life insurance. Now, term life insurance, so you guys know, from an analogy standpoint, otherwise known as the Toyota Camry, we're going to call this the Camry, is the basic edition of life insurance, okay? We're going to use an example of a 30-year-old who's purchasing life insurance, this particular plan, okay, this Toyota Camry, and we're going to say that the person is purchasing $500,000 worth of insurance, right? Now, 30 years is typically what life insurance will protect you on a term life insurance policy. You can get a 20-year plan, a 15-year plan, but we're going to use a 30-year plan because that's the most commonly used plan. If you're purchasing a 30-year plan, that means that if the person is 30 years of age, they're going to have 30 years of coverage, which means this person will be protected from 30 all the way to 60. This is their term period. Hopefully that makes sense. Now, how does this insurance policy pay out? It pays out a couple of different ways. Number one, it pays out as a death benefit. The person passes away, the beneficiaries, the contingent beneficiaries receive this $500,000, right? Now that's very traditional. We work with companies that have other benefits that a lot of people are unaware of. Other benefits called living benefits, LB. Living benefits means you don't got to die to get this money. Okay, but something has to happen within this time period in order for it to trigger an event for you to tap into this money. Living benefits means that these triggering events happen while you're alive. You don't necessarily have to pass away. What are some of the triggering events? Well, a chronic, a critical, or a terminal illness, right? A chronic illness, just so you know, is the need for having a nurse. If you all of a sudden aren't able to dress yourself, feed yourself, transfer yourself, bathe yourself, cognitive disorders like dementias, Alzheimer's, or anything like that, you can actually tap into this money tax-free, and it's a choice of yours to tap into while you're alive, and you can use that money for whatever you want. Most people will use that money at that time to pay for a nurse to take care of them. Some people know that as a long-term care insurance. The reason a lot of long-term care policies right now aren't necessarily purchased is because they only pay for long-term care. So if the person never needs a nurse, then they paid into those premiums for nothing. In this particular plan, at least, if you don't need it for long-term care, it at least serves as a life insurance policy. So that's chronic illness. The second is critical illness. Critical illness means you don't need a nurse and you're not dying, but you develop a critical illness. There's a list of different illnesses, things like cancers, strokes, heart attacks, organ transplants, organ failure, ALS, severe burns to the body, paralysis, brain trauma. There's a list of different things each company has that says if you have any of these things happening, you're going to be able to tap into this money. Think about cancer, for example. Cancer isn't, nowadays with the way medicine has advanced, cancer doesn't necessarily mean it's a 100% guarantee you're going to pass away. So some people are able to work through the cancer. Maybe it's a stage 1, a stage 2, or stage 3. But maybe while they're going through treatment, chemotherapy, or anything like that, they can't work. Having access to this lump sum of money gives them the ability to use that money to pay for the bills, to replace their income for a time period, maybe to pay for some alternative healing that they can use that maybe their health insurance isn't covering. It could be used to pay the deductible for their health insurance. And if they don't have health insurance, they can use it to pay for the health costs. Whatever it is, it's their choice. They can use that money to go hang gliding if they want to and take a vacation across the world and kind of bucket list their life if they wish to. At the end of the day, they have access to that if they wish to. And terminal illness means, hey, you've got less than 12 months to live, which is what most insurance companies operate on, 6 months or 12 months. You got 12 months left to live. The doctor's already declared it. We're going to give you access to this money so you can do what you need to do with it, right? So just understand this has death benefit and living benefits. Living benefits to me is an enormous thing. I got into this industry because of living benefits when my father in 2005 was hit by a waste management truck. He was disabled for 1.5 years. His insurance policy wouldn't pay out because it only had death benefit. And so he needed the living benefits to tap into it. So that 1.5 years was a bit of a struggle. And I actually became his living benefits. I'm the oldest of 3. And I ended up having to pick up 3 different jobs to replace his income because he wasn't working, my mom's income because my mom was taking care of him during his recovery process. This by far is the most cost-effective of the insurances that we have to offer. A plan like this, so that you know, positive, it'll probably cost anywhere from $40 to $50 per month. Fairly cost-effective, right? Very cost-effective. The negative, however, is that it does have an expiration. After the 30-year period is up, so once you hit right here, a day after this mark right here, you have no more insurance. You have 0 insurance. You lose the money that you put into it, and you've got to pretty much reapply if you want insurance coverage at that point in time, cross your fingers that your health hasn't changed and you can qualify for something like this, right? Now, there is a rider you can attach to this called a return of premium rider, which basically means after the time period has expired, you get a full refund, a return of all your premium payments that you've made. No questions asked, but you still don't have any more insurance. This is the Toyota Camry of insurances. So this one is one of the four that we're going to talk about today. Hopefully, this gives you a pretty good explanation of how it works. It's great for people that are on a budget. It's great for people that, maybe they get into a business arrangement and they want to make sure that the business owners are protecting each other, right? For a 10-year period, 15-year period. This is great for, for example, if a husband and wife get divorced and they have children, maybe the court will declare a certain amount of life insurance until the child turns 18, until a time period. This is great for mortgage protection. If you have a mortgage for 30 years or 20 years and you want to make sure that you can pay off that mortgage during that time period if something happens, this is a great solution for that, okay? It's not the solution for everything, but it's definitely a good solution for any of those things that we talked about. This is your first plan, the Toyota Camry, right? Now let me ask you, what is the upgrade edition to Toyota, right? What is the upgrade edition to Toyota, right? We know Honda's upgrade is Acura. We know Nissan's upgrade is Infiniti, right? So what is the upgrade to Toyota? It's Lexus. So let's talk about the Lexus edition of insurance. The Lexus edition of insurance is called a GUL, which stands for a Guaranteed Universal Life. The key word here, G, guaranteed. Guaranteed. I love that. When people talk about investments and such, they can't always use that word guaranteed. I can use this in the world of insurance, guaranteed, even though it is a universal product. Now, how does this one work? This product, same scenario, 30-year-old, is going to be protected until 100 years of age. That's a lot longer time period, wouldn't you agree? Right? 30 to 100, wow, that is a 70-year period of protection. We're going to use the same amount of insurance, 500,000 of insurance. Here's the great part about this. This has the same death benefit that we just talked about and living benefits. You know where living benefits becomes really attractive in this particular plan? Right here, between 80 and 100. There's a high probability between 80 and 100 that you might need nursing assistance. You might not want your children to become your nurses. That might not be something that you would ever want to burden your children with, but you might not mind if your children are the supervisors of the nurses. Well, with this particular plan, you could tap into the living benefits of it, right? The chronic illness that we talked about, and use it if you need a nurse to take care of you. It doesn't mean that you can only use it between 80 and 100. I'm just saying there's a high probability that you'll use it during that time. It's accessible between any of this time period right here. No problem, it's accessible, right? So you've got the death benefit, you've got the living benefits, you make your monthly payment, and as long as you're making your payments, you have this coverage guaranteed. What am I gonna guarantee? I'm gonna guarantee the death benefit amount and the living benefit amount. I'm going to guarantee the monthly payment, something like this, so that will probably run about $150 a month, somewhere around there, right? Now, be flexible with me with regards to the dollar amount, because your age, your health, your gender all plays a role on this price right here. So I'm giving you kind of an approximate so you understand the differences between the types of plans. This is around about $150 a month, okay? Now, I'm going to guarantee the price that you're quoted and approved for. I'm going to guarantee the monthly, the face amount. I'm going to guarantee the death benefit and the living benefit. I'm going to guarantee the time period that it's covered, as long as you do your commitment and make your monthly payment. I'm also going to guarantee one other thing. Right around the 20th year or the 25th year of you having the policy. So if you've signed up at 30, that means at 50, and then again at 55. If you signed up at 40, then it would be 60 and 65, right? So 20 years and 25 years after you've had the policy. Those two time periods, and only those two time periods, you get a return of premium option, which means, yes, you could cancel the insurance if you want 100% on the 20th year, or on the 25th year. You're given two opportunities. You can cancel it, get rid of the insurance, and get a full refund of all the money that you've ever put into this plan. All the money that you've ever put into this plan. Let me show you what that looks like. Say you're paying $150 a month for 20 years. That's $36,000 you get back. So ask yourself this question. Do you put $100, $200, $300 a month away right now in savings? And if something happened to you and you passed away right now, what would you leave your family with? Whatever you have in savings. What if you put it here instead? What if you knew that if something happened to you and you passed away, or something happened to you and you were still alive, but you needed the money, right? You needed the access to the money to replace your income, pay for the mortgage, pay for medical bills, pay for whatever it is, because you developed a living benefit need, right? You could tap into this large amount instead of the money that you've been putting away, because the money you've been putting away wasn't necessarily going into savings, it was going into premium payments. But on the 20th year or the 25th year, you could say, hey, listen, cancel the insurance. I don't need it anymore. Give me all my money back. Every single dollar guaranteed. And if you elect not to get the money back on the 20th or the 25th year, then you just keep making your monthly payments and you'll have the coverage all the way until age 100. Now, when we create these, we could make this stop period as early as 95 or as late as 120. I'm just using 100 as an example. So it could be a policy that's guaranteed till 95 or guaranteed till 100 or 105 or 110. So ask yourself, if you're interested in this, do you have longevity in your family? If you do, you got people in your family tree that have lived to 100. Maybe you want this to be guaranteed until 105 or 110. Might only be a penny or a dollar difference in price, right? If you don't, right, maybe you want to save yourself a little bit of money. You want to dial that back to 95. Not bad. Maybe you have a mortgage and you want to use this as a way to cover the mortgage, right? Like, let's just say hypothetically you have a 25-year or 30-year mortgage. On the 20th year, you could, of making your mortgage payment and making your premium payments, you can look at the balance of your mortgage that's remaining. You can look at how much money you get back if you exercise that return of premium and use that money to pay down the balance. Can you imagine if you were protecting your family by covering your mortgage, right? By covering your mortgage during that time period. And then on the 20th year, be like, here, take the rest of the money that I put into here, pay down the mortgage. And instead of having a 30-year mortgage, now you have a 20-year mortgage. It's a pretty cool product. Very, very, very cool product. I like this product because it's also a legacy tool. Some people might not want that money 20, 25 years from now. They might say, hey, listen, I'm going to liquidate all of my assets, use it for my retirement. This is the only thing I'm leaving behind for my family. I want to make sure it's here till 100. And if I'm liquidating all my assets, I want to make sure that if something happens and I have higher medical expenses because of medical conditions that qualify for living benefits, I can just tap into that money. Again, the choice for living benefits is a choice. You could take a portion of it. You could take the majority of it, whatever it is that you qualify for based on your condition. And it's tax-free. You don't got to pay it back regardless of the type of plan that you pick up. So what's the pro and con to this plan? Pro is the return of premium option. Very cool feature. It's automatically included. It's not, you don't have to add it in, right? Return of premium. And it lasts until age 100. So it's a great legacy tool. It lasts until age 100. The negative, all you're getting back is your money. You're not getting back any interest, any earnings or anything like that. So whatever you could have earned along the way for that 20, 25 years, you're really not earning it. You're just getting back your money. The reason I use a savings account as an example is because, let's be honest, how much does a bank pay us nowadays? 0.00035. 20 years from now, it's maybe, you've only maybe made $10. You know what I'm saying? You're not making much. So if you're going to put it in the bank, you might as well put it here and have this coverage in place, right? But you're not making any money. So there's no interest is the negative in this particular plan. This is my Lexus edition. Okay, now let's talk about the best of the best. Let's talk about what I like to call the Ferrari. This doesn't have to be a Ferrari to you. This could be a Bugatti. This could be a Lamborghini. This could be a Bentley, a Rolls Royce, whatever it is. I'm just going to use a Ferrari as an example. Okay, this is the Ferrari of insurances. We call these insurances LIRP, which stands for LERP, Life Insurance Retirement Planning. Do you know that there are investment vehicles that you could use and you can count them as an asset in your portfolio, not as an expense, leveraging the laws that govern insurance companies? Do you know that insurance companies are governed very differently than investment companies and much differently than banks? Do you know that? Well, let's talk about it. Okay, this is a product called the LERP, otherwise known also as an IUL, an Indexed Universal Life Plan. How does this work? Let's use the same $500,000 of coverage, except this $500,000 now has two components. One component to the left is the insurance. The insurance, again, you have a death benefit and the living benefit, and this will last you until 121 years of age. This is no longer an if I die. This is a when I die. This is no longer a, I focus on my first name. This is a last name type of a product because you're securing that you're leaving something behind for your family no matter what age you live, as long as you don't live past 121 years of age. I mean, let's be real, right? So you got that side of it. However, this side of it is the investment side of it. This side of it has a rate of return that it's going to earn. It's going to actually sit in an account that earns money. Okay. Now, what are some of the features associated to this? Number one, okay, you're going to have a floor guarantee. Okay, because the way that this earns money is based on the market. But rather than taking the money and directly investing it into the market, what it does is it mirrors the market, but only on a positive year. So you're going to have a guarantee that if the market crashes and goes into the negatives, you're going to get a 0% floor. So the worst thing that happens on a negative year is that you don't make anything, but you don't lose anything. It's pretty cool, right? The people that invest into the market are, frustrated, upset, they just lost 20, 30%. You're just saying, hey, listen, I didn't make anything, but I didn't lose anything either. I don't got to play catch up. That's a pretty good, that's a freaking phenomenal opportunity, right? The next thing you're going to get is a rate of return. That's another feature you're going to get. When the market goes up, you're going to make money with the market, right? So, that number going up, it could go up by, what's called a cap rate, right? So you could be limited to a 10% cap. So if the market does 15, you get 10. The market does 13, you still get 10. If the market does 9, you get the full 9, right? It could be by participation. You could make money based on a percentage of what the market makes. So if you're making a 110% participation and the market does 10%, you make 11%, right? We can get a little more detail later on if that's of interest to you. But at the end of the day, this side says the money that goes here has a floor guarantee. If the market crashes, you get 0%. You're not going to lose anything. But if the market goes up, you're going to make a rate of return based on the performance of how that market goes up. It's kind of cool because if you think about like a fair weather fan in sports, that means that you're only playing when the game is good. When the game is bad, I want nothing to do with the losses. I never want to have losses. Your portfolio kind of goes up like this now. Almost like a ladder. Because the market goes up, you go up, market goes down, you flatline. Market goes up, you go up, market goes down, you flatline. So you get that opportunity right there. A couple of the things that you're going to get out of this opportunity, you ready? The money that earns is tax-free. You're not going to pay taxes on any of your earnings. Holy crap, you're not going to pay taxes on any of your earnings. The one thing you cannot control is Uncle Sam's wrath. You can't control what Uncle Sam does with taxes. Right now, we're sitting in one of the lowest tax brackets of earned income. It's 34%, somewhere around there. Back in the 70s, it was up to 70%. During the Great Depression, it got up to 94%. When you retire, do you have a guarantee of where taxes are going to be? Do you know that your 401k right now is a pre-tax environment? You're basically saying, hey, listen, I'll worry about taxes later, but guess what? I have no idea where taxes are going to be later. Taxes might be low right now, but I don't know where taxes are going to be later. This gives you a place where you can grow money tax-free. Regardless of what Uncle Sam does with taxes, your money grows completely and utterly tax-free. Do you know the average rate of return on things like this? I mean, it could be anywhere from 4 to 6%, it could be 6 to 8%. Making 6 to 8% tax-free is the same thing as making 10, 11% in a taxable world, because your take-home after you pay taxes is what matters. Everybody knows that your gross income is not what matters, it's what you bring home. Tax-free means you're bringing it all home. Tax-free means it brings it all home. A couple other things for business owners, okay, is that it's creditor safe. 100% creditor safe. You can't be sued, garnished, levied against monies that's in there. And even in certain states, it's even divorce protected as well too. That's a big feature that a lot of people like about this side over here, right? Now, I've talked to you about so many pros. What's the con, right? I'm going to use this as the pro. What's the con? It's not short term. It is not in any way, shape, or form a short-term vehicle for you to put money into. Something like this, just so you know, the younger you are, the less you have to put in. The older you are, the more you got to put in. But I'm going to use $250 a month as a contribution starting point. By the way, you can do these plans on children as young as 2 weeks of age. 2 weeks after they're born, you can put them into plans like this. I got my children into plans like this. You could put 25 bucks a month, 50 bucks a month, 100 bucks a month. Can you imagine 60 years of compounding power at a 6 to 8% interest rate, tax-free, creditor safe environment for them? By the time they hit 60, I mean, the kind of money they'll have because the money's compounding and compounding for 60 years. Ask yourself, don't you wish you had 60 years to compound your money before you hit retirement? I mean, I'm 38. 60 years from now, I'm 98. I'm not trying to retire at 98, right? So I'm 38. I'm trying to retire by 55. Let's just say, I'm looking at a solid 17 years left to compound my money. I don't have that kind of time, right? But for a child, oh my God, right? And you can start with very small numbers. But for the adult, again, that 30-year-old that we talked about, you can start at $250 a month. What happens with the $250? Part of this money goes towards the premium payments to give you your insurance. The other part of that money goes into this bucket over here to grow your dollars. The reason it's not short term is because the first 10 years or so, right, this bucket right here has to grow with interest and your contribution to recuperate what you paid in insurance premiums. So if you treat it short term, I'll give you a guarantee you're going to get back less than what you put in. Guarantee you get back less than what you put in. Now, if you treat it as a long-term vehicle, depending on how long you're willing to go, you can 2x, 3x, 4x your money. And all those X's that I'm talking about, all that money over and above what you put in, completely and utterly tax-free. Now, if you think about it, the money that you put in was your paycheck money. That's already taxable. So if you're asking yourself, can I put pre-tax dollars in here? The answer is no. You got to put post-tax dollars in here. That's already been taxed. And then all your earnings are also taxed. That means it's all tax-free. And when you retire, you could say, hey, give me the lump sum, get rid of the insurance. Or let me take out a lifetime stream of income for the rest of my stinking life. Why is that more attractive? A lot of people say to themselves, hey, I'd rather take out what I need on the year that I need it and leave the rest in there to continue to grow. Maybe I could just live off the interest. I mean, this is a strategy that the Wealth of America has been leveraging for years. 401k, been around since 1978. This tax strategy has been around since 1904. So think about it. Wealth of America loves to go here, avoids here at all costs. Loves to go here, avoids here at all costs. Wealth of America's business owners. Wealth of America creates 401ks. Why? Because it's a tax write-off to them, but they put their dollars right here into these types of strategies right here. Right? So again, I talked about the pros and the cons. This is the Ferrari of plans. You could set this up at 200 bucks a month, 300 bucks a month, 1,000 bucks a month. Right? Companies like JCPenney survived the Great Depression leveraging plans like this. Walt Disney World opened up Disney World in Orlando leveraging plans like this. John McCain funded an entire campaign for presidency leveraging plans like this. General Electric today, just so you know, their board of directors is about 5 individuals, all 7-figure earners, place anywhere from $80,000 to $300,000 into strategies like this. 80% of the CEOs in Fortune 500 companies place their dollars here. Why? Creditor safe, tax-free, strong rate of return, floor guarantees. I'll give you another one. Another big benefit to this is that you don't have to wait till you're 59 and a half to tap into this money. 401ks, IRAs, Roth IRAs, you got to wait till 59 and a half to tap into the money. Otherwise, you pay a penalty. You can tap into this money before 59 and a half. Use it for whatever you wish without any kind of penalty whatsoever. Okay, guys, this is the Ferrari of Ferraris, but there is a need. There is a need in this world. For Lexuses, there is a need in this world. For Camrys, it's just a matter of what is it that you're looking for out of your insurance protection. Maybe you're saying, hey, I want to grow my cash. If I have insurance as an ancillary, great, cool, no problem. Maybe you're saying, no, listen, I want to have insurance, but I also want to leave behind a legacy. I don't want to worry about expiration dates, but I also need to, I love the concept of putting money in as an asset, not as an expense. I want to make money as well too. This could be a solution for you. I don't know. I'm telling you there's a pro and con to every one of these vehicles. Now, I've talked to you right now about 3 types of products: the Camry, the Lexus, the Ferrari. I'm going to talk about the 4th right now. The 4th, I'm going to tell you, is for the person that says, you know what? I'm young. I don't need insurance right now. I'll worry about it later. So this is the person that says, forget the Camry, forget the Lexus, forget the Ferrari. I've got other places to put my money. I don't need insurance. I mean, whatever reason it is that you have for not getting insurance, you've now hit that 55, 60 year of age bracket, and you've realized, holy crap, I don't want to burden my family with the final expenses of paying for my funeral costs. Okay, let's talk about that plan. That plan, I'm going to tell you right now, I call it the PINTO. Now, I call it the PINTO because you got no choice. At that age, 55, 60 years of age, if you don't have $1,000 a month to put away into, a Ferrari type of a product, then you have no options. You have no more options. If you don't have $1,000 a month to put away into a Lexus type of a product, you have no other options. And at that age, term insurance isn't even a viable option for you. You've got limited choices. So this is a cost-effective option you have. We call it the PINTO. How does the PINTO work? Well, number one, it's going to cost about $70 per month. It could cost $100, kind of depending, right? There's a little bit of a glare there on the light. Let me move this over a little bit here. Right, it's going to cost about, let me see here, put it up here, $70 a month. Okay, how does it work? How does this plan work? It's only going to be anywhere from $2,000 to $40,000 of insurance. So that whole concept of $100,000, $200,000, $300,000, that's already out the window. You're limited to between $2,000 and $40,000 because this is known as final expense insurance. It's there ready to cover your final costs, right? So it's $2,000 to $40,000. You make your $70 payment. So let's say you're 55 years of age, you'll have it until 120 years of age. As long as you make your monthly payment, you're good. You've got a death benefit, pass away. You have living benefits, but they're limited. Your living benefits are limited to 2 out of the 3. Living benefit number 1, terminal illness. Living benefit number 1, terminal, you're about to die, less than 12 months left to live, get access to that money. Living benefit number 2, chronic illness. You need a nurse to take care of you, tap into this money, but this money, since it's not a lot of money, probably exhausts itself pretty quickly. You can use it for that. What you don't have here is critical illness. Critical, cancer, strokes, heart attacks, organ transplants, all that stuff we talked about, not accessible into a plan like this. It's a very cost-effective solution, $70 a month, to cover your final costs, make your monthly payment, you're good. Now, one of the biggest questions people ask is, well, listen, if I pay into this for 10, 20 years and I've paid in enough money that I've paid in more money than the insurance I have, what happens? If you put in equal dollar amounts of money to what the amount of insurance you signed up for, you no longer have to make payments any longer. And now your insurance policy is what's called paid up. You're done. You're good. You ain't got to make no more payments any longer, right? If for whatever reason you don't, the maximum time period you will make payments into is till age 100. Right, so when they price it so that by age 100, typically, it's fully paid up. You don't got to make any more payments to it. But if you happen to pay it up faster, you don't got to make any more payments. So you don't got to worry about, oh my God, I've put more money in than the amount of insurance I'm going to get. That'll never happen. Never happen. Best case scenario, you've paid it off completely. You don't got to make another payment. Now you've got this insurance policy guaranteed for the rest of your life when you pass away. This is how the PINTO works. Some insurance companies do have what's called a 2-year wait period, which means if you sign up for it and you pass away within the first 2 years, the most they'll give your family is whatever amount of money you've paid into it. Right? So you have to wait 2 years before this death benefit and this living benefit kick in. After that 2-year period, boom, the full dollar amount is there to go. So you've now learned about the 4 types of insurances. You've now spent some time with me. And you probably have a couple questions. You probably have a couple things that you're interested in. You probably have maybe 1 or 2 things that you're interested in. Here's the next thing I need you guys to do, okay? Whoever sent you this video has a strong interest in sitting down with you and having a consultation. 0 cost for that consultation, by the way. And if it's a newer agent, okay, more than likely, they're probably going to bring with them one of our certified trainers, a specialist, an expert in the industry. Heck, who knows? It could very well even be me. That actually will sit down and have that consultation with you. Okay, 0 cost for that consultation, but they sent this to you because either you expressed interest in insurance as a in a non-solicited fashion, or they solicited to you and you said, hey, I am interested in learning more, and therefore you're watching this video. Here's the next thing you're gonna do, okay? As I said to you in the description here, there's a link. It's a Google Doc link, okay? So if you've got Gmail, perfect, open it up. Google Doc is the same thing as Microsoft Word. When you open up that link, there's going to be an exercise for you to do. The exercise is going to do a couple things. The first exercise is going to be what's called a dime analysis. This is an analysis we use to determine how much insurance you need. Because you might say, hey, I'm interested in this insurance, that insurance, give me the Camry, give me the Lexus, give me the Ferrari, but how much insurance is still a question. You don't know if you need $500,000 or 200,000 or 500,000. You don't know how much you need. So the dime analysis will help you figure out how much insurance it is you need. The next thing that you're going to do after that is a budget, right? Why is the budget important? Because guess what? You might want the Ferrari, but unfortunately your budget only allows for a Lexus, right? Or your budget only allows for a Camry, right? Sometimes we want more than what we can do. Maybe you want, or in reverse, you want the Ferrari and you think you can only do 200, 300. And then after you do a full budget on yourself, you're like, holy crap, I got a lot of money left over. I want to do 500, 600, 700 bucks a month into this. But the budget is crucial for us to do when giving you a proper recommendation. And then after that, you're going to answer a couple questions about yourself, about your significant other, about your children. Maybe you don't have any of those. Either case, I want you to go through that full exercise. When you're done with that exercise, I want you to contact the agent that sent this to you and say, hey, listen, I finished watching the video. I listened to Tony for 30 minutes talk about the different types of insurances. I'm interested in this insurance. And by the way, I just did this exercise. When can we have a consultation? Let's schedule something. Now, if you're smart, you'll follow the steps in the beginning of that Google Doc. The steps in there will show you how to make a duplicate copy. Number one, have your own copy. And then number two, how to share that file with the agent that sent this over to you. That way, when they schedule a follow-up with you, they can actually take a look at that analysis first and have some numbers ready to present to you when they do set up that meeting with you. I appreciate the time that you guys have given me. I appreciate the fact that you've expressed interest in protecting yourself. I'm a big believer of insurance protection, retirement planning, credit protection. Those are the areas that we specialize in. We've got countless companies that we work with. We would love nothing more than to add you as one of our clients that we've been able to help. We'd love to help you through the journey. We'd love to be able to see you go through your life changes, from your kids graduating, going to college, getting married, having kids, whatever it is. And we'd love to make sure that your finances are always in alignment with where you are today. Have a good one. Be blessed. Be safe. And hopefully one day we'll get a chance to meet. I'll shake your hand and say, good job for making the right decision and taking the right actions to your future. Bye-bye.